Hello, this is Professor Hazare again for the third of these 4 videos on this one problem. We've already gone over the text of the problem at 80% acquisition, January 1st, 2011. The parent purchased for $450,000 worth of capital, and goodwill is split 100 to plant assets undervalued with a 4-year life and to goodwill. And there's a couple of reciprocal payables, receivables, and then, but number 3 here, that's going to be an error in the problem, not an error in the problem, but an error that was written into the problem that will make our investment balance different than the one we calculated. And the one we calculated actually is correct, but I want you to notice what it says. A $20,000 dividend was declared by SCI on December 31st, 2012, which is the end of this year, was not recorded by Pat using the equity method. So what we've got to do first, before we start the big 4 entries in the consolidation entry, the first thing we have to do is make a correction for the fact that the parent did not record an equity method entry that it should have recorded, so it's not reflected in its books and in the investment account. So let's go over here. This is where we stopped last time. So notice the investment account on the parent's books has a balance of $560, whereas the one we calculated has a balance of $544. Well, that's a $16,000 difference. And the $16,000 difference is equal to, and I'll just put here $16,000 error is result of P not taking out dividends of $16,000 from its account, from its investment account, and I'm just going to put in here that's $20,000 times the 80% ownership. Okay, so this is correct. This number is correct. What is not correct is that 560. So the first thing we have to do is actually do what the parent should have done in the first place and do an equity method entry in the consolidation, but in real life the parent would then have to go back and do it permanently in its own books for that $16,000. So the first thing we have to do is, it was declared but not paid, so we've got a dividend receivable, but then, and if it had been paid, you just debit cash, credit investment. However, since it's owed, you debit dividend receivable, and you've got to take it out of your investment account. Now, after having made that entry, that 560 here, which is incorrect, we've subtracted 16,000 out of it. That's 16,000 right there. So now, theoretically, it would be 544. Now we can do our regular entries. Okay, the first entry is always based on all these first entry. The first and second entries are always directly out of this calculation. The first one takes the investment account from its end of year balance to its beginning of year balance. Take out the income from sub, take out the dividends, and the difference will be the $44,000 difference between the end of year balance of $544 and the beginning of year balance of $500,000. Now we're ready to take out the $500,000. Okay, so we're just going to go down. Common stock at 100% is $400,000. Retained earnings at 100% is $100,000. Buildings are going to be, now these are the correct, remember that every number above this line right here is there are the correct beginning of 2012 amounts. So the number for building that we're going to have to take out is equal to 100,000 plus the 25, the negative 25 or minus 25,000. That you're going to get for 75,000, because that's the correct amount as the beginning of 2012. That would have been the beginning of the second year, and you would have recorded $25,000 in depreciation the first year. So you'd have $75,000 left over to begin the second year. So $50,000 for goodwill, and then all we've got to do is take out the beginning balances for the 80% and beginning balance 80% and establish the non-controlling interest of $125,000. And let's see, I just like to make sure that my entries are equaling So I'm going to go ahead and sum my debits it should be able to fix that. Sum my debits and sum my credits. So home, copy. Get to see the copy. Paste. So it looks good. Okay, the next, so the first of the big four entries takes your investment account from ending balance to beginning balance. The second eliminates the beginning balances and establishes your entry, so your non-controlling interest. And we did have this correction entry here, but at this point, your investment account has been credited for $16.44.5 million. So that's the whole 560. Gets rid of it. The third of the big three just records depreciation. Now the depreciation here should be very easy, since it's equal to a negative, really 25,000. That plus the negative 5. This is this year's depreciation. So this is to record depreciation for 2012. Now at the end of this year, your plant will have 50,000 left over because you had 100,000 less the 2011 depreciation and less this depreciation should give you 50,000 at the end of this year. Okay, and that one. Okay, the fourth of the big three entries is to update our non-controlling interest, and that really is based on this table right here. So that's non-controlling interest income, 125,000. The dividends will eliminate, and we'll change the sign there. We'll eliminate dividends are 8,000, and so wait a minute. The income is 19,000, not 125. Okay, and so the difference is that it went up by 19,000 income. Took out 8,000 dividends, so you have non-controlling interest went up by 11, and that 11 is equal to the beginning. The difference between the beginning and ending. 125 to 136, difference is 11. Okay, so it's all reflected in that table. Okay, so now we've got a couple of reciprocal payables, receivables. This book that I took this problem out of used to love this stuff. So go back to the problem. Number one, there's a $10,000 reciprocal accounts receivable payable. So we'll debit 10,000. So we'll debit accounts receivable for 10 and credit. We'll debit accounts payable for 10. We'll credit accounts receivable for 10,000 also. Okay. Next is dividends payable, dividends receivable. Now we know from the correcting entry that the subsidiary owes the parent 16,000 dividends, and that was a correcting entry. But you can't, if you're going to consolidate, you can't owe yourself dividends. You can't owe yourself anything. So we're going to have to debit dividends payable, and we're going to credit dividends receivable for 16,000. And then finally, and this is not anything I put on a test. The only thing is that to complete the problem, what was written is you'll notice it says Cy mailed its check. That's poor English. It should be a check because they haven't referred to the check yet. But it's Cy mailed a check for 40,000 to Pat in settlement of the advance. Well, they're talking about, if you look, it says down here, it said advance to Cy for 40, but you know this is an old book because the check was in the mail type thing. So it should be one way to do this, since the check was in the mail, was to debit cash for 40,000, and so that would be plant's cash, the parent's cash, the check is in the mail, and credit advance to Cy for 40,000. So that's those are the entries right here. And so the only thing that's a little tricky, a couple things. You have to do this correcting entry, and most problems don't have this, but this is a CPA exam problem, and they love to do it. You can't get away from those things. You have to be able to spot those things. In this case, this 544 was correct because we took all 40 out, but in the problem it says that half of that was declared at the end of the year, and so this original 560 was overstated because it hadn't taken that out. So we had to credit the investment account for that 16,000 right there. The other tricky part, a little bit tricky, is that, and this is going to be very important for your test, is that buildings right there, 75,000, and the reason we took 75,000 out is because you wrote them up January 1, 2011 for 100,000. For 2011, you took out 25. So at the beginning of the year, they had a $75,000 balance. But of course, in the next, we do the consolidation, you'll see we actually write those down to 25,000. Anyway, so those are the entries. I'll put this video up, and then we'll proceed from there. Thank you very much.